I'm Steven, the calculator guy, and today we're going to talk about sturdy finance. For good reason. It's a pretty interesting protocol. It's a very nuanced type of money market, you might call it. And there's no interest rate on borrowing, which is probably the most mind-blowing thing. How does that happen? Well, let's just dive in. As you can see, by the way, there's roughly $24.4 million in TVL on this protocol, and you can see sort of how that's broken down by some of the deposited stablecoins they have here. It is on ETH mainnet, but also on Phantom Network. For the sake of this video, we're going to be talking about ETH mainnet because that's where most of the opportunities are. And they recently released a new form of LP collateral, which means a new type of leveraged looping, which means a new fun and interesting stable yield. So let's get right into it. How does Sturdy work? Well, the way Sturdy works is investors or loopers or people who want to sort of make money off of leveraging their LPs can come in here and deposit their LPs. And that leveraged looped interest is sort of given back to them, but also a portion of that is given to lenders. Right, so people who are just lending their stablecoin assets. So this APY is not coming from borrowers paying it; it's coming from borrowers' yield, a portion of the borrower's yield. So this makes this market much more efficient, right? Instead of there needing to exist borrowers who are coming out and borrowing the USDT and borrowing the USDC and borrowing the DAI, instead leveraged yields, portions of the leveraged yields are paying for these assets. Paying to entice lenders. Why is this so important? Well, it's important because this means that you can have a sort of dynamic fixed base level APY, which they do. USDT, USDC, and DAI generally are fixed around 5.87%. And then after they hit a particular utilization rate, which means like after a certain percentage of the total available is borrowed, then the APY sort of skyrockets. You might see it up to like 40% in some cases. And of course, then people are not going to borrow that asset. They're going to go borrow a different asset. Utilization goes back down under this specific margin, and you get these low APYs again. But still pretty interesting for any lenders, right? Institutions would love a 5.87% APY. Trust me. And that APY is coming from the yields on these LPs, the leverage yields. And you might be thinking, what? Those yields are so small. It's 0.7%, 0.62%. Well, that's because they're not leveraged yet. So if you were interested, first of all, as just being a depositor, maybe you're a big fish, right? You don't want to kill the yields on these, but you're interested in getting maybe a 5% on $100,000, $200,000. There is a reality in which you can, because as a reminder, right, there's already 7.2 million here. So if you drop $200,000 in USDC, you're not really going to affect this. I mean, look, the utilization is already so high that this one has the highest APY, and this is the one with the most deposited in there. So you could come in here, right, deposit your USDC as much as I don't have much right now because I'm using it in another strategy. But you could deposit USDC right here, right now, and be getting around 5%. Now, of course, you might say, hey, bonds are better in TradFi, in CFi can do better. Well, that's totally true. But I will tell you, there are many institutional investors who look at a 5%, pretty consistent, that can handle a couple $100,000, and they're enticed by that. So if that's you, here you go. Congratulations, you have an opportunity. But for people like me, smaller investors perhaps, or people who want to deposit maybe $10,000 or maybe want to deposit $5,000 or $1,000 or $500 and want to loop that up to get maybe something around 13+%, there's a place you can do it here. But you have to understand the risks, and so we're going to go over that. We're going to look at two opportunities in particular, the Curve Frax USDC LP and the Curve TUSD Frax BP. Now, you must understand the assets that you're playing with, right? Frax is not a fully or over-collateralized stablecoin. It is a partially or mostly collateralized stablecoin. I can't tell you the exact ratio, but I believe it's within the 80% at the moment. Collateralized, and the rest is algo collateralized by FXS, which makes some people uncomfortable. However, it has been doing incredibly well so far, and for what it's worth, Frax is sort of like the flagship for this type of asset. And you know, while I will say that I don't know if it will maintain its peg forever, I will say that I like the asset for whatever that's worth, right? I like the team is good, the assets performed very well under, the UST depegging, USDT depegging for a little bit when it went to 95 cents, MIM depeg, like all those things had their very volatile events. Frax has, in spite of all that, performed incredibly well. So, just know that you are exposed to Frax here. And you also have a TUSD, which is an over-collateralized stablecoin. And then USDC, which you guys know is a collateralized stablecoin, collateralized by, I think, now government bonds as well as a bunch of other investments. But, it's Circle. So they have buku cash. So Frax and TUSD, USDC, those would be your stablecoin exposures. As long as you're comfortable with those, then you can move on to actually doing the investment. So let's look at Frax USDC. First, you would need to get the Frax USDC LP, right? You can see I currently have 0. Well, how do you get this LP? You go over to Curve. So let's go to curve.finance. This is mainnet again, remember that? And you want the Curve Frax, so you go over to pools, and you're looking for Frax. This is Frax USDC, is that correct? Frax USDC, so you would just hop in here, and you don't want to swap, right? You don't want to be swapping, you want to be depositing. So you're going to be depositing. And then you can either deposit Frax or USDC or a mixture of both to get your Frax USDC LP. The important thing here, I have 0 of any of this. The important thing here is that you do not deposit and stake in the gauge. If you deposit and stake in the gauge, then you're only going to be getting the base APYs on Curve, and you won't be able to, your receipt will not be composable. Which is a word you probably hear all the time in DeFi. Composable just means usable elsewhere. So you will not have a receipt that's usable elsewhere. If you just deposit it, then you will get a receipt that is usable elsewhere, that is composable. You can take that receipt over here, shove it in there, and then if you don't want just the 1.7 or whatever it was APY, you can click this beautiful, wonderful little button here, and then drag it over. And you can see your APY will be 11. Let me zoom in here for you guys. 11.68%. That's pretty good for stablecoins. I know some people are not going to get out of bed for anything less than like 25%, especially if there's like Frax involved. But some people will find this incredibly attractive, especially because 100% of that yield is coming directly from Curve, right? So it's either swap fees or very small incentives from like FXS or something of that nature. All of it is compounded back in, so you are not being exposed to any sort of farm tokens. This is relatively organic yield. I think that's great. However, look at that gas. That gas is intense, right? So gas being $4 and $5, I might want to see if a flash loan's cheaper, and it is, right? Flash loan makes this much cheaper and increases the APY. Now that's a little trick that, I don't usually show people. However, I haven't made content in a while. I feel bad for it. So there's a cool little trick, right? You use the flash loan instead, you reduce your gas substantially, and you increase your APY. It is a win-win all around. I don't know why no is defaulted. I think it's just maybe there's something going on there. I'm not going to speculate. But if you just click that yes, you've effectively taken 75% of the cost of the gas away, and you've increased your APY. Let's see, 3. It's almost 25%. So, incredible little bit of a trick there. So let's go over to my drive really quickly just to work some math, just to see like when would this be a good strategy, when would this not be a good strategy. So we have a bit of an idea. Right, so let's say we're getting what, 13%? Let's see, 13%. Gas is $90, right? $90. So $90 is 13% of what, right? I forget exactly how to do this. You do 90 divided by 13%, $690. So you would have to invest at least, at least this plus the 90 because you're paying the 90, right? You would need to be investing at least around $800 to make this worth it after a year, right? So you're probably going to be wanting to invest at least a few thousand, or else this is not going to be worth your while. And you should know if it's going to be worth your while before you invest. You don't want to go over there with $500 and be like, all right, you know what? 13%, that's good. $90 in gas, fine, so be it. Because then it's going to take you 2 years to get that back, and who knows what the APY is going to be like, right? But if you're investing like, I don't know, let's say $5,000, and let's say you're getting 13% of that, times that, then you're getting around $650 per year, paying $90. It's a win-win all around. Hey, buddy. Whoa, cool sticker. Okay, so that's really cool. Now let's look at the... I may have to end it there because my kid has come back home and they're attacking my green screen. But basically, this is how Sturdy works. And so, you know, you can loop these up, leverage these up, and when the utilization ratio goes to a certain height on the borrowed assets, whether it be DAI, USDT, or USDC, then the APY sort of spikes rather substantially. I do recommend checking out the documentation there. But finally, if you're interested in more strategies, we've been talking about this one for months in the DeFi Dojo Discord, greatest Discord on the entire planet. Go check out DeFi Dojo. We offer 1 month free, so you can go there, hang out. We have AMAs, we have community calls. You can see my portfolio. We have people talking about funding rate arbitrage. You know, we're getting roughly between 20 to 35% on stables and delta neutral plays, and it's just amazing. And you can be there for a month for free. Test it out, see if you like it. If you don't like it, you can leave. Never pay a penny. Highly recommended. Link in the description. Love you guys. Thanks for watching. Have a wonderful rest of your day.